The silver price you see is no longer real. Two prices now exist at the same time. One flashes on screens, updates every second, and tells you silver is plentiful. The other only appears when you try to buy it. And that second price is higher, tighter, and getting harder to access. That contradiction is not theoretical. It directly affects what you can protect, what you can sell, and what still works when stress hits the system. Here's the uncomfortable detail most people miss. The so-called world spot price isn't set by physical silver at all. It's set in a paper market where nearly 400 paper ounces trade for every single ounce that actually exists. On paper, supply looks endless. In reality, dealers are scrambling, sovereign coins are scarce, and sellers are refusing to let go. But here's the part nobody says out loud. When the paper price and the physical price separate, markets stop behaving the way you expect. Liquidity changes, trust changes, risk moves closer to you. So which price matters when you actually need the metal? Because this split didn't happen by accident. And once you see why, the rest of this story clicks into place. What's happening now didn't start with a single headline or a sudden spike in demand. It's part of a longer pattern that's been quietly building underneath the market. The core event looks simple on the surface. Paper silver keeps trading smoothly, while physical silver keeps getting harder to move, harder to source, and harder to price. But that's only about 60% of the picture. The remaining part is what turns this from a market quirk into a structural issue. The pricing system most people rely on was designed for speed, leverage, and settlement without delivery. It works perfectly when confidence is high and nobody asks for the real thing. But the moment more buyers start demanding physical possession, the system starts revealing stress fractures. Notice how the signal doesn't come from charts, it comes from behavior. Dealers charging premiums they can't justify on paper. Wholesalers slowing purchases even as prices rise. Sovereign products quietly going out of stock. Here's the reframing question that matters. If a price only exists where delivery is optional, is it still a price or is it just a reference number? Because once that question enters the market, everything downstream begins to shift. Here's the claim that makes this uncomfortable. The silver market is no longer discovering price. It's managing appearances. That's not opinion. It's visible in how the market is built. For every single ounce of physical silver produced, nearly 400 paper ounces are traded through futures contracts. That means the number you see quoted as spot is derived almost entirely from leveraged promises, not from metal changing hands. On camera, on screens in real time, the market signals abundance. But now notice what's missing: physical settlement. When buyers actually try to take delivery, the experience changes. Premiums jump, inventory disappears, dealers stop honoring the screen price because they can't replace what they sell. The paper market says one thing, the physical market responds as if supply is already gone. This is where the meaning shifts. A price that can't clear real demand isn't discovering value. It's delaying reality. And delays only work until someone insists on delivery. Notice what you don't hear denied. No one claims the paper to physical ratio is small. No one says physical supply is comfortable. No one explains why availability keeps tightening while the screen insists nothing is wrong. This is where the story flips, because once price discovery breaks, everything built on it starts misfiring next. What happens next is escalation, not collapse, and that distinction matters. This kind of split has happened before, just not this wide. In past stress moments, paper markets wobbled briefly, premiums spiked, then things normalized. But normalization only works when supply can respond. This time it isn't. Instead of tightening for weeks, the gap is persisting. And persistence is how abnormal becomes routine. Watch what's being normalized. A market where the official price is treated as optional. A system where dealers openly ignore spot just to stay alive. A situation where availability, not price, becomes the limiting factor. That's not how a healthy market behaves. but it's starting to feel familiar. Here's why that's dangerous. Once participants accept that the screen price doesn't matter, behavior changes permanently. Sellers hesitate, buyers rush, middlemen pull back, liquidity thins out, not because demand vanishes, but because nobody wants to be the one caught trusting the wrong signal. Now watch how fast this escalates. The longer this split holds, the more participants adapt to it. And once adaptation sets in, reverting to normal gets harder, not easier. Because the next phase isn't about price at all, it's about bottlenecks. And one of those bottlenecks is already quietly locking up the system. Here's where the evidence gets sharper and harder to ignore. The breakdown isn't just happening at the trading level. It's happening inside the supply chain itself. Refineries, the place where silver is supposed to re-enter the system, are quietly refusing large categories of material. Not because silver lost value, but because they can't process it fast enough or at all. Historically, refineries accepted both pure silver and alloyed forms like 90% constitutional silver. That balance kept liquidity moving. Now that balance is gone. Refineries are prioritizing only 0.999 fine silver, the kind that can be quickly assayed and pushed back into industrial or exchange-ready form. Everything else is being capped, delayed, or rejected. Here's the contradiction that changes how you see the market. On paper, silver is liquid. In reality, entire classes of silver can't be sold downstream at any reasonable price. Wholesalers are getting stuck holding metal they technically value but can't move. Notice what that implies. This isn't a demand problem. It's a processing problem. And when processing breaks, recycling breaks. When recycling breaks, supply tightens permanently. This is where the story stops being about price manipulation and starts being about capacity limits. Because when the system can't recycle its own metal, the squeeze doesn't release. It compounds. And the reason behind that bottleneck is more revealing than it looks. Now the pressure starts stacking fast. Refineries aren't just refusing alloyed silver, they're doing it because a key input is missing: nitric acid. Without it, separating silver from copper becomes slow, expensive, or impossible. And that chemical is no longer flowing freely into civilian refining. At the same time, industrial demand isn't easing, it's being prioritized. High-purity silver is being pulled into strategic manufacturing that doesn't recycle cleanly and doesn't come back. Once used, it's gone. Add a third layer. Wholesalers, seeing this jam forming, start protecting themselves. They cap buy prices. They slow intake. They refuse to act as unlimited liquidity providers even while the screen price rises. Not because silver is weak, but because the exit door is narrowing. Speed matters here. None of these moves are dramatic on their own, but together they compress the system. Less refining, less recycling, less wholesale flow, more hesitation at every handoff. This is how markets lose flexibility, not in a crash, but in a squeeze. So pause on that question. At this point, the story stops being abstract and starts landing on you. Because when systems tighten like this, the impact doesn't show up first on charts. It shows up in everyday friction. You walk into a shop and the product you expected to be there isn't. Or it's there, but the price has nothing to do with what you saw online. Or the dealer hesitates before even quoting you a number. For ordinary people, this changes behavior, not ideology. Behavior. People stop trusting screens. They start asking different questions. Can I actually get it? Can I replace it if I sell it? Will this still work if banks slow withdrawals or add conditions? That's why more buyers aren't chasing upside anymore. They're chasing certainty. Physical possession, no counterparty, no appointment, no permission. When access to your own money starts coming with friction, alternatives stop feeling extreme. They start feeling practical. And this isn't limited to one group. It's spreading quietly, person to person, conversations at work, in line, in passing, people comparing notes, not theories. If this feels familiar to you, say so in the comments. Because once everyday people start adjusting their behavior, systems feel it next. Here's the part that rarely makes it into mainstream coverage, because it isn't dramatic, it's mechanical. Systems don't fail because people panic. They fail because incentives quietly stop aligning. In this case, every major player is being rewarded for doing less, not more. Refineries are incentivized to take only the easiest inputs. Wholesalers are incentivized to cap exposure. Dealers are incentivized to protect inventory. And buyers are incentivized to remove metal from circulation entirely. No one has to coordinate this. The structure does the work. When processing capacity is constrained, risk rises. When risk rises, liquidity pulls back. When liquidity pulls back, prices stop functioning as signals and start functioning as warnings. Here's why that detail changes everything. Markets are supposed to move metal from weak hands to strong hands. But when fear of replacement sets in, metal stops moving at all. It freezes. This isn't about conspiracy. It's about leverage and priority. Whoever controls processing, chemicals, and industrial demand dictates who gets served first. Everyone else waits. And once a market starts rewarding hoarding over exchange, it doesn't unwind easily. It locks. The next question isn't whether this is real. It's how long the system can operate like this before the pressure forces a decision. From here, the path forward splits, and neither option is clean. One path looks calm on the surface. Paper prices continue to trade. Volatility comes and goes. Headlines declare stability. But underneath, physical availability keeps thinning. Premiums stay high. Replacement becomes uncertain. In this path, the system survives, but only by becoming less honest. The screen price remains, but fewer people trust it, and fewer transactions actually clear at that level. The other path is faster. Pressure builds until something forces alignment. A delivery failure, a policy shift, a sudden surge in demand that can't be papered over. In that scenario, price doesn't rise smoothly, it gaps. Not because silver suddenly became valuable, but because the old reference point stops working. Notice the uncertainty baked into both paths. No one knows the timing, but momentum is visible, inventory isn't expanding, processing isn't loosening, behavior isn't reverting. Here's the key detail. Markets don't wait for consensus to change direction. They move when the marginal participant changes behavior. And that shift is already forming. The next move won't be announced. It will be felt. Here's the insight that ties all of this together. This isn't really a story about silver. It's a story about what happens when trust in abstractions erodes. Prices, accounts, promises, settlement systems, they all work until they don't. And when they don't, people don't debate theory. They default to what can be held, verified, and moved without permission. The silver market is showing you that transition in real time. One price for narratives, another price for reality. One system optimized for leverage, another for survival. And the gap between them is where stress accumulates. If you zoom out far enough, the pattern is simple. When systems become too complex to trust, value migrates back to fundamentals. Not overnight, gradually, quietly, then suddenly. This is why following these signals early matters. Not to panic, not to speculate, but to understand where the next fracture is likely to appear. Because this isn't the end of the story. It's the setup, and the next chapter is already taking shape.